Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So what if I told you the Federal Reserve might be about to mathematically erase inflation?
Oh, wow. Mathematically erase it.
Yeah. Not by actually, fixing the economy and definitely not by lowering the prices at your local grocery store, but by literally changing the way they calculate the math.
I mean, honestly, it sounds like a complete conspiracy theory, right? But according to recent analysis we've been looking at, it is a very real policy shift that is currently being debated at the absolute highest levels of the U.S. financial system.
Yeah, it's wild. We are looking at this impending changing of the guard. So incoming Federal Reserve Chair Kevin Warsh he's preparing to take over on May 15, 2026.
Right around the corner.
Exactly. And the data shows he wants to change the thermometer the Fed uses to read the economy's temperature. Now, to be clear from the jump for you listening at home, the Fed is not abandoning its official 2% inflation target.
Right. No, that is still the stated goal.
Yeah. Instead, this entire debate is about how they interpret the underlying trend of prices, like how they determine if they're actually hitting that goal.
And, while debating different inflation metrics might sound like incredibly dry, boring accounting,
Oh, totally.
the real-world implications are massive for everyday people. The outcome of this debate directly determines whether interest rates stay high, which, makes mortgages, car loans, and your credit card debt way more expensive, or if those rates finally get cut.
Right. So to understand why a new thermometer matters so much, we have to kind of look at the alphabet soup of metrics the Fed currently uses.
Right, there are a few.
Yeah, whenever people watch the evening news, they usually hear about the CPI, or the Consumer Price Index. But the Federal Reserve actually prefers a completely different metric called PCE, which stands for Personal Consumption Expenditures. Let's start there. Why do they prefer PCE over the metric everyone else uses?
So the simplest way to think about the difference is really just how they handle consumer behavior. The CPI assumes you buy the exact same basket of goods every single month, no matter what.
Regardless of the price.
Right, exactly. But the PCE index, which the Fed prefers, accounts for the fact that you, the consumer, are a smart shopper.
Okay, makes sense.
Like if the price of beef absolutely skyrockets one month, you probably aren't going to buy as much beef, right? You'll substitute it with chicken.
Yeah, you adapt.
Exactly. So PCE tracks what consumers are actually spending their money on as prices fluctuate, which economists argue gives a much more accurate picture of real-life economic pressure.
That makes total sense. So within this PCE metric, there are different ways to grade the economy. Let's use a simple everyday analogy for this deep dive. Think of measuring inflation like trying to figure out the average behavior of a massive class of students.
I like that.
Yeah, so the first metric we have is called headline PCE. This is looking at every single student in the room, no exceptions. You just add up the cost of everything people buy and you find the average increase.
Right.
And according to Dallas Fed data from March 2026, the 12-month headline PCE was sitting at an uncomfortably high 3.5%.
Which is deeply problematic when your stated mandate is to get that number down to 2%.
Yeah, exactly. So because 3.5% looks terrible, economists often look at a second metric, which is core PCE. Core PCE is like looking at that exact same classroom, but kicking out the two students who are always the most chaotic and unpredictable before you calculate the class average.
That's troublemakers.
Right, the troublemakers.
Right.
And historically in economics, those two chaotic students are food and energy. Now, I used to think this was just, the government trying to hide the true cost of living from us.
Oh, a lot of people think that.
Yeah. But there is an actual economic mechanism behind why they exclude food and energy, isn't there?
There is, yeah. And it really comes down to what the Federal Reserve can actually control with their tools. The Fed manages inflation by raising or lowering interest rates to either cool down or heat up consumer demand.
Okay.
But food and energy prices are often driven by things completely disconnected from underlying consumer demand. So like if a sudden brutal freeze ruins the orange crop in Florida, the price of orange juice is going to double.
Wow. Yeah.
Or if a geopolitical conflict breaks out, global oil prices might spike overnight.
And the Federal Reserve raising interest rates in Washington, D.C. isn't going to unfreeze the oranges in Florida.
Precisely. Raising borrowing costs for everyday Americans won't fix a broken oil pipeline or a bad harvest. So economists look at core PCZ to see what the rest of the economy is doing, stripped of those random weather or geopolitical shocks.
Got it.
But, the current data shows that even with food and energy kicked out of the classroom, March's core PCE was still running really hot at 3.2%.
Yeah, so both of the traditional thermometers are flashing red. And this brings us to the third metric, the one that incoming chair Kevin Warsh is reportedly drawing a lot of attention to right now.
The trimmed mean.
Yes, the trimmed mean PCE. And it's calculated specifically by the Dallas Fed. Instead of just blindly kicking out the food and energy students every single month, regardless of how they behave, the trimmed mean does something much more, well, surgical.
Surgical is a very good word for it. It looks at the entire economy and simply drops the extreme outliers on both ends of the spectrum for that specific month, whatever they happen to be.
But the parameters of what they drop are just wild. According to the Dallas Fed's methodology to calculate this trimmed mean, they remove the bottom 24% of extreme price drops, or sluggishness.
Okay.
And then they chop off the top 69% of extreme price spikes.
Yeah, that's a huge chunk.
It's massive. Once you remove those huge outliers on the fringes, you find the average of whatever is left in the middle. That sounds exactly like Olympic gymnastics score.
Oh, that's a perfect comparison.
Right. You have the panel of judges, but you throw out the judge who scored you way too low, you throw out the judge who scored you way too high, and you just take the true average of the sensible scores in the middle.
Yeah, and the underlying logic there is that you are trying to find the true persistent signal of inflation by completely stripping away the extreme noise.
But, okay, I have to push back on this on behalf of anyone listening who currently feels like they are drowning in living expenses. They chop off the top 69% of price spikes.
That's the math, yeah.
If a company looks at their balance sheet and just erases the top 69% of their highest expenses, we call that accounting fraud.
Fair point. Fair point.
I mean, if you look at the 6-month annualized data from this recent analysis, the trimmed mean is sitting way down at 2.2%. But the headline number, the reality of what things actually cost, is up at 4.3%. Doesn't using the trimmed mean right now feel like a very convenient excuse for policymakers to just, ignore how expensive life is actually getting?
Your skepticism is entirely warranted. And honestly, you are highlighting the exact reason this debate is so fiercely contested right now among economists.
Yeah.
The trimmed mean makes inflation look like it is functionally cured. I mean, a 2.2% reading is practically at the Fed's 2% target. It paints a remarkably reassuring picture.
Right.
But the traditional metrics show inflation is stubbornly stuck in the 3 to 4% range. So the obvious question becomes, if the trimmed mean has such a glaring blind spot, why would an incoming Federal Reserve chair want to use it?
Exactly. So let's look at the bull case for it first. The logic of economists who support the trimmed mean is that their goal is to completely strip out tail risks.
Tail risks, yeah.
Right? So let's say there is a sudden one-off tariff spike on imported steel. That is going to cause a massive sudden spike in the price of anything made with steel. But it's a one-time adjustment. Once the new price is set, it doesn't keep inflating month after month.
And that is a crucial distinction. A temporary price shock is very different from persistent structural inflation. Should a temporary spike in the price of imported steel force the Federal Reserve to slam the brakes on the entire U.S. economy by keeping interest rates punitively high?
Probably not.
Right. Proponents of the trimmed mean argue that in normal economic times, when the economy is relatively stable, this Olympic scoring method is actually a much better predictor of where inflation is ultimately heading over the next few years than the core metric is.
But we aren't operating in a vacuum, right? And we have to acknowledge the political reality of this moment. Based on recent reporting, President Trump is currently in office, and the administration clearly favors interest rate cuts to stimulate business growth and lower borrowing costs.
Absolutely.
Because the trimmed mean is currently the lowest of all the available inflation metrics, leaning on it makes it mathematically much easier to justify the exact dovish policy, meaning rate cuts, that the current administration is looking for.
The political backdrop definitely adds a massive layer of intense scrutiny to any shift in how the Fed interprets its data. But, politics aside, there is a very real mathematical danger to relying heavily on the trimmed mean right now, which is something the Dallas Fed themselves have actually pointed out.
Yes.
Yeah.
This was my biggest takeaway from the research. If you systematically chop off the top 69% of extreme price changes, What happens when literally everything starts getting expensive at the exact same time?
That's the billion-dollar question.
Right. If the whole classroom starts acting chaotic and you just ignore the craziest 69%, aren't you completely missing the fact that the school is on fire?
You are. You totally miss it. The Dallas Fed actually published a warning about this specific vulnerability in an analysis from April 2026. They cautioned that when inflation broadens out, when price hikes aren't just isolated to one or two weird sectors like steel or oranges, but start spreading across everyday goods and services, the trimmed mean can be dangerously slow to react.
Wow.
Yeah, in statistical terms, they note that when the skew of the price distribution turns heavily positive, the trimmed mean completely fails to capture the true momentum of inflation.
And we have a very recent historical parallel for this. Back in 2021, when inflation first started creeping up, the trimmed mean was incredibly late to catch the massive spike that eventually caught everyone else by surprise.
Right, it completely missed it.
It chopped off so many high prices across so many sectors that it completely missed the broader macroeconomic trend.
Which is exactly why financial firms, like Evercore, for instance, are warning that changing the focus metric to the trimmed mean right now looks suspiciously like goalpost shifting.
Oh, that's a great term for it.
Yeah, if you can't get inflation down to the 2% target using the standard measurements, you simply change the measurement tool to one that gives you the answer you want.
Goalpost shifting perfectly describes the fear here. And this theoretical debate over which mathematical model is best is currently colliding violently with what is actually happening in the real world as of May 1st, 2026. The data from late April paints a very grim picture for the American consumer.
Yeah, the macroeconomic landscape has shifted dramatically in just the last few weeks.
We are seeing a massive real-world shock. The ongoing war involving Iran is causing global oil prices to completely spike. And you don't need a PhD in economics to understand the downstream effects of that. It is putting immense immediate pressure on gas prices. Household budgets are getting squeezed hard. And crucially, the short-term inflation expectations from everyday consumers, people actually swiping their credit cards at the gas pump in the grocery store, are climbing again. People are psychologically preparing for things to keep getting more expensive.
And consumer expectations are the Federal Reserve's worst nightmare.
Why is that?
Because once people expect inflation to stay high, workers demand higher wages to compensate. Then businesses raise prices to cover those higher wages, and you get a self-fulfilling wage price spiral. This current energy shock raises an existential question for the Federal Reserve.
Yeah.
While the trimmed mean might be sitting comfortably low, essentially whispering that everything is fine, the current sitting Fed members are looking at that headline inflation of 3.5%. They are watching the energy shock unfold, and they are highly alarmed.
It is causing absolute chaos behind closed doors. At the late April Federal Open Market Committee meeting the FOMC, which is where they set interest rates, recent analysis indicates there was the highest level of disagreement among Fed members since 1992.
Over 3 decades of relative consensus and unified messaging from the central bank just completely fractured.
It's crazy. Some current Fed members are so worried about this energy shock spiraling out of control that they are saying they need to keep the door open for rate hikes, not cuts. Hikes.
Yeah, which is a massive pivot.
Which brings us to a phrase from the analysis that perfectly captures this moment: the family fight. Kevin Warsh takes over the chairmanship on May 15th. He is going to lead his first major policy meeting on June 16th and 17th. And this family fight is going to be in full swing the minute he sits at the head of the table.
The ideological divide at that June meeting will be historic. On one side, you have the current Fed members who view this oil spike as the start of a broader inflation fire that needs to be aggressively extinguished with tight monetary policy.
And on the other side,
You likely have Warsh's camp who might view the oil spike as a temporary price level adjustment.
meaning they think oil prices have simply stepped up to a new, higher plateau, but they aren't going to keep inflating by 10% every single month forever. Therefore, the Fed shouldn't overreact.
Exactly. The central question of 2026 is whether the Federal Reserve treats this as a temporary anomaly to be ignored or a systemic crisis to be fought.
Okay, so how does this battle of the thermometers actually impact a beginner investor who is just trying to navigate these wild markets and build a portfolio today? Let's decode how the market is reacting first.
If you look at the global investor perspective right now, major brokerages have been aggressively pushing back their expectations for 2026 rate cuts. At the start of the year, everyone expected multiple cuts.
Right.
Now, many analysts are predicting no rate cuts at all this year. The broader market is currently much more terrified of how long this energy shock from the Middle East will last than they are interested in which math equation Kevin Warsh happens to prefer.
I want to break this down into a clear playbook for the listener, depending on who wins this family fight at the Fed. Let's start with interest rates and stocks. If Kevin Warsh's logic wins out, meaning the Fed decides to focus on the lower trimmed mean number and look past the oil shock, they might hold interest rates steady or even cut them.
And traditionally, a stable or lowering interest rate environment is the absolute best-case scenario for long-term growth stocks, particularly in the technology sector.
Let me try to explain the mechanism behind that, because it's really crucial for new investors to grasp. When you buy a growth stock, you aren't usually buying it for the profits they are making today. You are buying it for the massive profits they promise to make 10 years from now.
Exactly.
But to figure out what those future profits are worth today, analysts use a formula that discounts those future cash flows based on current interest rates. If interest rates go down, the discount rate goes down, which mathematically makes those future profits look much more valuable in today's dollars. It allows company valuations, what we call expanding multiples, to grow.
That is a spot-on explanation. Growth stocks are highly sensitive to the cost of borrowing. So if Warsh pushes through a dovish policy based on the trimmed mean, you can generally expect growth equities to really rally.
But what about bonds? Because bonds are traditionally the safe haven of any portfolio. But inflation is absolute kryptonite for fixed income. Like if you buy a 10-year bond that pays a fixed 4% yield, but inflation is running at 5%, you are actually losing purchasing power every single year.
Which is exactly why you have to pay very close attention to the gap between the trimmed mean metric and actual consumer inflation expectations. If consumers are experiencing high inflation at the grocery store, but the Fed is keeping rates artificially low because the trimmed mean says inflation is handled, traditional long-term bonds become a terrible investment.
You're just tracked.
Yeah, you are locking your money up for a decade while real-world inflation eats away at your returns.
So in this confusing environment, short-term bonds are much safer because you aren't locking your money away for long periods. You can reinvest at higher rates much sooner. Or, even better, you look at TIPS.
Yes, Treasury inflation-protected securities. TIPS are government bonds where the principal value actually adjusts upward alongside inflation.
Oh, that's a cool mechanism.
It is. If the Federal Reserve chooses to ignore the reality of inflation by using a trimmed metric, but that inflation is still happening in the real world, TIPS are designed to mechanically protect your purchasing power regardless of what narrative the Fed is pushing.
That brings me to the asset class that has the most fascinating divergence in all of this. Gold versus the US dollar. There are two completely different outcomes here depending on who wins the family fight. Let's look at the first scenario. If the Fed uses the trimmed mean, ignores the oil spike, and cuts rates, actual real interest rates might fall into negative territory.
Because the real interest rate is just the nominal interest rate minus inflation. If inflation is running at 4%, but the Fed cuts interest rates down to 3%, your real return on cash in the bank is negative 1%.
And historically, when real interest rates fall into negative territory, gold becomes a massive winner. Because if holding paper currency guarantees a loss of purchasing power, investors flee to hard assets that just can't be printed. Gold thrives when people feel the central bank is falling behind the curve and losing control of inflation.
But consider the alternative scenario. What if the current Fed members win the fight? What if they look at that headline inflation of 3.5%, they panic over the oil shock, and they stay extremely hawkish, meaning they keep interest rates very high or even hike them further to kill the inflation fire?
Then the US dollar becomes the ultimate winner, because higher interest rates attract global capital. If an investor in Europe or Asia can get a massive risk-free yield simply by buying US treasuries, they have to buy US dollars to do it. That immense global demand for yield drives the value of the dollar straight up.
So your entire investment strategy over the next year depends almost entirely on which thermometer the central bank ultimately chooses to read.
Which brings us to the core takeaway from all of this data. Going forward, as an investor trying to protect your wealth, you shouldn't just be asking, what is the inflation number? That's actually the wrong question.
Right.
You must ask, which inflation number does the Federal Reserve actually believe? Because one number tells them to cut rates and stimulate the economy, and the other number tells them to hike rates and brace for a recession.
And that leads to one final thought, something really fundamental to chew on as we watch this play out over the coming months. The Federal Reserve's power doesn't just come from its ability to print money. It comes from the public's belief in its credibility.
The trust factor.
Exactly. If the central bank successfully changes the lens through which it views inflation, if they switch to this trimmed mean and proudly announce to the country that inflation is a nice low 2.4%, but everyday consumers are still getting absolutely crushed at the gas pump and the grocery store,
Right.
what happens to the public's trust in the institution itself?
It evaporates completely.
Yeah. Does the thermometer even matter if the patient feels like they are burning up?
Don't forget to subscribe and hit that like button.